Hello, and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Mettle, and today I'm honored and very excited to introduce you to Mark Miller. He's a financial powerhouse. This guy's got nearly 40 years of experience guiding business owners, executives, high net worth individuals to legally slash taxes, grow wealth, and build lasting legacies. In the pre-show, we were just talking about how he guides entrepreneurs to get to a zero tax bracket status, which is my favorite tax bracket of all time. So we are going to definitely get into that. Mark's also the CEO of Hilton Tax Wealth Advisors, alongside co-founder Bradley Hilton, grandson of the legendary hotelier Conrad Hilton. He's a best-selling author of Hilton Wealth, How to Invest Like an American Dynasty, a book revealing the strategies used by Fortune 500 firms and America's wealthiest families. Mark also is the manager of the family home office, so he's a wealth manager for the Hilton family, and just a tremendous amount of knowledge that we're going to share in this podcast. So, Mark, thank you for coming in on a Friday to have this podcast. I'm fired up to be with you today.
Well, I'm fired up to be with you too. It's great to be here on Good Friday.
It is great. It's going to be great Friday when this podcast is over. So thank you. So, Mark, let's jump into it. Now, nearly 4 decades in the market. You've seen a few highs, you've seen a few lows, you've ridden out some storms. But how did you originally get into this field, and how did this journey that you've been on eventually lead to the creation of Hilton Tax Wealth Advisors?
Well, I came straight out of college and went to work for IDS American Express as a broker. I worked for American Express for a number of years, and I was kind of a wide-eyed young kid, just excited about money and kind of learned kind of the retail side of the business and the brokerage side of it. And as years went on, I was fortunate to have get a couple of very wealthy clients that started to introduce me to a different way to do invest. A lot of tax strategies too, introduced me to different trust companies and kind of got me off of that kind of brokerage retail side and into what we call the institutional or smart money side. And a lot of your listeners may have heard that term before. What is the smart money doing? And so for years, I've worked in that space, primarily as a business financial consultant. Met the Hiltons years ago. And they asked me a number of years ago to be the manager of the Hilton family office, but there was a lot of internal things going on in the family, and I kind of declined at the time. And about 5 years later, Brad Hilton came back, who's a very good friend of mine, and he said, "We need you desperately." And I did that, and then Brad and I started Hilton Tax Wealth Advisors, which is our passion to bring these advanced, kind of the wealthiest of the wealthy strategies that the smart money folks use. Generally, you got to have 20 or $30 million to even step in the door and have access to these things and bring them more down to Main Street through Hilton Tax Wealth Advisors. So that's kind of the arc of my synopsis of kind of the arc of how I've been in this business. And along the way, I learned a lot on the retail side, but I learned a lot what was wrong with the retail side. And I'm just so happy that probably for the last 20 years, I've been on the kind of higher end institutional side of the business.
What a cool journey. What was coming up for me as you were talking about that is I was recently looking at a stat that the top 10% wealthiest families in America own 67% of the wealth in America. So if you think about that, that's a cohort of a roughly 35 million Americans out of roughly 350 million Americans that are controlling greater than two-thirds of the wealth. And we always say that, rich people are rich not because they have money. They're rich because they have the information and they have the strategies. And over time, that creates the secrets of the super rich, which leads me into my next question for you. So, in your book, and the things that I hear you talk about a lot is this secrets of the super rich. So talk us through a few of the key strategies that you see ultra wealthy use to create multi-generational wealth, to avoid taxes. And then also for those people who aren't ultra
side. So the retail folks on Wall Street want you to focus on returns.
Mhm.
They're basically playing to your greed, and which is ironically, you think maybe fear would be more powerful than greed, but really, especially on the retail side, returns, that greed is more powerful in the long term. People will take a lot of risk and a more risk than they really need to so they could get those returns. So, great example is like on the retail side. What is the biggest chunk of money that's invested in the retail side is generally in mutual funds. Well, how do they sell those? The 1, 3, 5, 10-year performance, right? And people will pick mutual funds all day long, especially if they're doing it themselves, just from that. Well, this one looks like it's got a pretty good track record, and I like that return. I'm going to buy that mutual fund. Okay. So um, the returns are secondary to very wealthy people or the smart money. The first thing that they're focused on is safety and security. In essence, maybe more focused on fear because
Mm.
they have a lot more to lose. If, let's say, you have 20 or 30 or $40 million, you better make sure the majority of that is protected and secure, because when you make more money and amass more money like that you have a lot more responsibilities to keep that money safe and secure. You've got employees, you've
Yep.
got family, extended family members, all of that. So the first and foremost thing to know is that the wealthiest of the wealthy, and even the Warren Buffetts of the world, are this way. Most people hear Warren talking about Berkshire Hathaway and all this equity stuff, and he's this great value equity investor and all of that, which is great, but they don't know that 60% of his portfolio is rock solid, safe, and secure. 40% of his portfolio, he's rolling the dice a little bit with, okay? Which is a little more actually than a lot of wealthy people. Often they'll only take 15, 20, 30% of their wealth and use that to get their returns over time. So that is huge. And that's the biggest distinction between the two. So, Will, when we set up our Hilton True Wealth portfolios for clients, the first thing we focus on in the two biggest buckets is a lot of safety and security. Then if something really goes bad in the economy, then we have that to fall back on, and there's massively less volatility in the portfolios as time goes by too. So
That's
that's
really
the number one thing in a nutshell.
That's really interesting. That dovetails with what, we talk to clients all the time about, which, we see clients putting every dime of their down payment money from the sale of one home into the next home, and then funneling every dollar to pay down that mortgage. And I'm looking at their financial situation. I'm going, yeah, but you have no liquidity or nest egg outside of your mortgage. And in a time
Yeah.
of a downturn, the only way to get that out is a sell. And if you're selling in the time of a downturn, you're going to take a huge
You
loss.
take a 50% hit or whatever it is. Yeah. Yeah.
So that really lands and validates the advice that we give. We have to balance the return. In this case, that would be the return of saving interest with the liquidity factor of if something goes wrong, you've got 12 months worth of reserves there. You've got assets growing in another asset class that you could draw off of. What would be it? So
Absolutely.
that's a tactical advantage from my vantage point. Could you give us another tactical,
Yeah.
an actual strategy that would illustrate what you just talked about?
Okay, so one of the things that we do, we bring these advanced high-end portfolios a little more down to Main Street. We use kind of a bucket concept, and you can read about this in my book. But the first bucket is a guaranteed safety bucket. We might have 8 to 10 different types of offerings that will go into that at any given time. The second bucket is generally will be a guaranteed income bucket that will throw
Mm,
off income. And those are our two kind of safety, very secure buckets.
the
And then we're
foundation.
gonna, and then we're also a third bucket we're going to have is kind of the advanced institutionally based money management bucket that we've kind of all heard of somewhat, but it's more again on the institutional side, not on the retail side, where we're doing tactical investing and we don't have the ability to lose tons of chunks of money at a given time because we're using, generally in the top 10 of all money managers in the world that we're plugging people into. But that is at-risk money, but we can adjust that according to what their risk levels are. And then the fourth bucket, and you and I discussed this before the podcast here. The fourth bucket is huge, which is the private equity, the alternative bucket, which would include the real estate investments that I know you do a lot of and so forth. But then various other offerings that we have to invest directly in individual privately held companies or different
Hmm.
debt offerings or things of that nature that are offered by private equity firms that the Hiltons have had 2 or 3 decades experience with. And so we break it up that way. So what's the advantage to that? Well, number one, it helps us design a portfolio that focuses, number one, on security, number two, on lots less volatility than regular retail portfolios that are usually going up and down all over the place. The old, the old 60/40 portfolio that doesn't work anymore, by the way. And will also, the one thing that the smart money folks do not like and they despise is fees.
Mm.
So our portfolios are, we eliminate probably, and most people don't know in their retail portfolios, they have no clue there's hidden fees and then the 1% they pay. So most people, when we do our analysis, are generally paying anywhere from maybe 2 to 3% in their portfolios. In the kind of institutionally designed portfolios, what we call the Hilton True Wealth portfolios, that's maybe 1/4% for the entire portfolio. So what does that mean? Less volatility, less fees means being able to get another percent or two, or sometimes 3% more per year, which is huge over time.
Okay, this is very, very helpful. And I'm going to get a little bit into the weeds here just because I'm
Mhm.
super curious. So you
Yeah.
described the four buckets and
Yes.
you gave me an insight into what the potential assets or investments would be in bucket number four. And that's
Yes.
the bucket that is the last bucket to be filled, but it's likely to be highest return, but perhaps highest volatility.
Absolutely.
Could you just
At
give me an
highest risk.
idea, like what is in bucket one, two, and three? Just like hypothetically, what
So
kind of
remember I mentioned in three, it's institutionally managed money. It's a
okay,
managed money portfolio.
stocks.
They're generally, yeah.
Okay,
Stocks, commodities, and they're
okay,
usually world economically balanced portfolios.
makes sense.
We've got the best in the business that do that, and then we just determine what makes the most sense in there. In our guaranteed income bucket, generally we'll use maybe private equity firms we've worked with for quite a while that have different high yield offerings, but then we'll back up those whatever monies go in by 100% coverage if something goes wrong. Or
Uh,
often it depends because the Hiltons generally won't work with just naked private equity offerings. They'll say, well, yeah, we'll bring our funds in here, but we need to know that we have 4, 5, 6, 10 times coverage if something does go wrong. So in essence, we have, and you've probably heard this term before, and some of your folks on here have, what we call surety on the smart money side, that there's a lot of surety to it. That first bucket might be brokered CDs, might be insurance-based products that pay high yields. They may be also government bonds. It depends on what the offerings are at a given time that we kind of plug into those buckets. Okay.
that makes a lot of
Yeah,
sense.
so real balance, they're very balanced, but the good news is there's lots of different offerings available in each one of those buckets. It's not just one individual offering, and this is what goes in that bucket.
And just to clarify a word that you used, assurity, that you mentioned in
Yeah.
bucket number two, I believe.
Yeah.
What that another word for that would be insurance.
Well, no surety. The word
Surety.
surety on the private equity side, or say institutional side, I would say, means generally that maybe you'll be with an offering that generally could be even a naked offering that you go in and you just say, hey, put my money in here. It sounds great. I know I'm going to make returns. And everybody we worked with forever. I mean, so, we know that nothing's generally going to go wrong, but there's no backstop. The surety, like what I mentioned, is a lot of our offerings is like if we have a private equity offering and it's directly in a private company, then if somebody puts, say, 100,000 or 200,000 into that offering, then we need to know from that issuer that they've got assets to back that up if
Ah,
something goes wrong.
so
So
they're going to get paid first in the case of a liquidation.
absolutely. And whether
Got
they're
it.
in a preferred stock position, whether they have direct liens against assets, things like that. That's something that's really unique about us. And we've been able in the 3 years that we've worked with Brad and we've done Hilton Tax and Wealth Advisors, we've seen no other firm in the entire country that has a structure exactly like we do, especially on the private equity and alternative side where we can get that kind of surety to know that, again, if something does go wrong, hey, we could still get in the mid-teens or higher, depending on what it is. But if something does go wrong, we're assured our principal back, which is huge.
I think it was Warren Buffett, but it may have been his partner Charlie Munger, who said, rule number one in investment, don't lose money. Rule number two, don't lose money. Rule number three, don't lose money. So
Yeah,
you
they're
just,
like, keep looking that rule one number one, right?
yeah, refer to rule
Don't
number
forget
one.
rule number one. Yeah.
Yeah, yeah.
Well, that's exactly, I'm glad you bring that up because that's exactly kind of what we try to get across to our folks. Because a lot of people on the retail side, even when they're very exposed and they're at a high risk, that they think they're still kind of safe.
Hmm.
As opposed to the wealthiest of the wealth, they know how safe they are. They know what percentage is safe and not safe, and they know exactly how their portfolio is going to act if something really goes wrong in the economy or something along those lines. It doesn't go their way.
So if we're going to play by those rules, rule number one, don't lose money. Rule number two, see rule number one, then we obviously are going to have a lesser potential upside or return than if all our money was in bucket number four. So
It
that,
depends.
okay,
It depends.
okay,
That is another kind of myth that is sold on the retail side. The
okay.
risk reward thing, that
Uh-huh.
it's just set in stone. It depends on the offerings that you have. I mean, we have private equity offerings that have paid 20% plus per year, but yet they have very little downside associated with them. So that how does that play to the normal retail side, what it truly is risk reward? Okay. The reason there's risk reward that's structured like that on the retail side is there's only one reason for that, and that is so they can make their fees. Okay.
Mm,
Really, it's them taking spreads and taking bigger spreads because a lot of those retail offerings, the market makers will build into their offerings a big spread profit for themselves, and they will make the lion's share of the profit, and the retail investor never even knows about it. Never knows.
got it.
So on the institutional side, if they call them smart money investors for a reason because they're smart. They know the business, okay? You're not going to pull anything over on them if you do. If you come into the institutional space and you're not a, above the board of straight shooting issuer, people are going to find out really fast. And guess what? You're not in that space very long, okay? So they have to be totally transparent, and they have to and then the investor has to know that they're getting the lion's share of the returns, and it's not the issuer taking it.
Got it.
Yeah.
I love that you've taken this concept that are used by family home offices like the Hiltons, and you've brought it down to the place where people can enter these types of strategies with obviously a lot less wealth than the Hilton family has in their home office. So that's fantastic. Let's switch gears a little bit to actually what I thought you were going to say was rule number one, which was don't pay taxes.
I
But I
haven't even
know
got to that yet.
yeah, I know these things, dovetail together in some ways. So let's talk about tax strategies because that's,
Yeah.
the difference that I notice when I talk to a wealthy investor. Usually, one of the first questions is, what's the tax consequences from this investment, or what's the tax shelter from this investment? And when I talk to somebody who isn't as wealthy, they're more just interested in the return or the upside.
Yes.
So,
There you go. Exactly.
so lead us into this conversation around how you help businesses, owners, and executives slash taxes like the 1% do.
Sure. So we talked a lot about investment strategy, but part of investment strategy is tax strategy. And here's what I always tell, especially my business owners. Most really good business owners, they have a marketing plan. Obviously, they have all their financials set up. They have plans for everything and all of that, but they have zero tax plan. And
Mm,
the tax plan is what truly will make you the wealthiest over time. Because, I mean, we have clients that we see every week, new clients come in and they're paying 40, 50, 60% of their taxes. They're so used to it. They've done it forever. And they are shocked to when we show them that we can put a simple formal tax plan together for them. Usually the first year can cut their taxes in half over and above what their CPAs are already doing because most people don't know it. But even though they think their CPA is a money guru, 95% of the CPAs out there are not tax planning CPAs.
mm.
They are, yeah, they know the codes and people think they're smart because of that. Part of it's they just read the codes and they're exposed to it every day. They most of them just have advanced versions of TurboTax in their office, and they're just putting the numbers in for you. They're historians. What'd you
Mm.
do last year? Give me all those numbers. Great. Let's get your taxes done. Okay. But most people believe that they're saving them everything they can save on their tax because they're a CPA, right? And they're a good person. They think they're pretty smart. They're easy to work with. Well, okay, they've already told me they can't do anything different. So it's the old adage, you don't know what you don't know until you know it.
Right.
Well, how do you know those? So you have to have proper access. You have to be exposed to the right parts of the industry that do these things for a living and show people how to compound it. The cool thing about saving money on taxes, and we get most of our folks to the zero tax bracket over time, is that in the early years, oh, well, okay, great, we just saved 50,000 on our taxes or 40. That's wonderful. Oh, I got that chunk. And now the great thing about it is that money then can be deployed
That's right.
into building your wealth. And over time, it is massive. It can put hundreds of thousands, if not millions of more dollars in your pocket just by cutting the taxes or getting to a zero tax bracket.
It's great. Okay, so let's talk about some of those strategies. What are the things that are overlooked? What are the tax strategies that you're helping people reduce their to the preferred zero tax bracket? And
Yeah,
and let's bring in real estate investors because I
sure.
believe if entrepreneurs aren't going to be real estate investors, they should own the real estate that their businesses are in. So let's talk about some of those strategies that you're using.
Absolutely. And it's interesting you mention real estate because the great thing about real estate, there's built in some tax advantages already.
Mhm.
Now, we have some of the CPAs that I'm not a CPA myself, but we We outsource to the best, really proactive tax planning CPAs in the country, and some of them are the best of the best in the real estate side. So with a real estate person, we generally layer some other strategies in there beyond just depreciation or the normal things that they're used to, because we have people go deeper into the weeds of the tax codes. Um, but there's bulwark strategies that most CPAs don't use because, and it's not because, and you'll hear this all the time, we don't want to do any extra strategy. Or if somebody hears about a strategy and they come to their CPA, a lot of people will identify with this. Their CPA will go, well, I kind of looked at that. And yeah, it doesn't look too bad, but I would highly recommend you not, because it could, what's the word, that it could trigger a red flag, right?
Yeah. Yeah.
Most of the time that is code for, I don't want to mess with doing what's outside of what we normally do. I do 500 tax returns, I get your tax return, you pay me for the tax return, and I move on to the next tax return, and I stay within this. And you could understand that, because CPAs are technicians, right? So they have a process and they want to stay in that process. So anything out of the bounds of that, they generally, and in the industry, it's kind of a running joke that CPAs, the word they use most is no. So don't do that strategy, don't do this strategy. Well, here's the thing we've always said, and the Hiltons have always been this way. Wait a second. If it's in the code, and the code even maybe outlines there's 3 or 4 different ways to do this, and you do it, how is that going to automatically trigger a red flag? Well, maybe it's something you knew that you did, and the IRS might send a letter and go, hey, can you send us some documentation? Yeah, here's all the documentation. Thank you very much. We'll talk to you next year. Okay. So what we do is we put formalized tax plans together. We usually have bulwark strategies that are deep dive code strategies. Maybe add 3 or 4 or 5 of those that they're not doing already, that aren't the normal things that CPAs generally do, a little deeper in the codes. And then the next level is, most of the folks we take to advanced tax mitigation strategies, which are some of them proprietary strategies through the Hilton Financial Network, various strategies, all within the code, all are IRS, battle hardened, and well tested, and have been done hundreds of times. But these are things that we've used for years and years, that again, most people, especially people that are on the smart money side of the business, have never had exposure to, and don't understand until we explain it to them and say, this is how it would work, and here's how it's designed into your tax plan.
So, of course, most of our listeners are entrepreneurs, self-employed, medical professionals. They may own multiple practices, and taxes is obviously a huge concern and a huge opportunity for them.
Mhm.
Most of our listeners are going to be familiar with tax strategies such as cost segregations, 1031 exchanges, depreciation, those types of things. What additional strategies outside of those are you employing that you could kind of give us some ideas around? Or is that
Yeah.
the primary vehicles for reducing the tax bracket status?
Well, what you just mentioned there are still kind of some bulwark strategies
Okay.
that CPAs should be doing with their clients already.
Hmm.
So most of our strategy, a lot of them are proprietary to individual issuers that we work at. We work with a firm called the Due Diligence Project, which I won't go in too much into this, but in the family office world, it's all about due diligence. Everything is about due diligence. So we have a number of firms we work with, one in particular, the Due Diligence Project, that is made up of the top 500 to 600 proactive planning CPAs and tax attorneys in the country, like the best ones. They have to pay a lot of money to be part of it. And our home office, our I'm thinking of tax strategies.
Yeah.
Our family office uses that firm amongst other firms to do like a 146 point checklist every year, where they
Wow.
go deep dive into these strategies. And every year we have different offerings and different strategies that are more proprietary offerings that aren't like, if I tried to explain them right now, it would be probably too much into the weeds.
Okay.
But they're designed to be compliant with all the codes, but they're higher end strategies that wealthier people will use. That again, we brought down to Main Street and structured them so folks that, let's say you're paying, 50,000 in taxes or 100,000 in taxes, can be privy to and plug into.
It's great. So
Yeah.
I wrote down we want to be working with tax futurists, not a tax historian.
Ah,
I love
excellent.
that word. Most
Excellent
CPAs,
distinction.
yeah, are a historian of what happened, and they're just essentially doing accounting, if you will, to send. We want to work with somebody who can tell us if we shift things this direction. And this is what Robert Kiyosaki teaches in Rich Dad, Poor Dad with the cash flow quadrant, right? He talks about,
Mhm.
you want to get you want to orientate your business so that you are in the big business or the investor quadrants, because those are the most tax efficient and they have the greatest amount of leverage. So, what is it going to take to shift the way you're operating business today to fit so you fit in those quadrants so you
Yes.
legally qualify for all those deductions?
Yeah. And one of the things he talks about also, and that we do really well, is taxes run through the veins of everything we do. Because there's a lot of tax strategies and even advanced tax strategies that can be put into portfolios too, via, different trust vehicles, all of that, a little more complexity, add a little more complexity, but give us even more tax savings and more than just, oh, am I in a qualified account as opposed to a non-qualified account? That's basic retail stuff. It start diving in deeper. How can we start shifting monies that are even, highly taxable monies? How can we start shifting them to different quadrants that are completely tax-free? That's another thing that we do with all our clients when they're with us long enough and they come on board is we start designing their portfolios to where in a given amount of years, we've structured everything, no matter what they have, to throw off tax-free income. So they're not hit with kind of that tax time bomb when it comes retirement time, and they've got $2 million sitting there. Doctors are a great example, work with tons of physicians that they have $2 million, $3 million sitting there in qualified funds. And what's the first thing they don't want to do with those funds?
Pay
Pull
taxes.
money out of them,
Yeah.
right? What's the purpose?
Yeah.
The IRS and the legislatures in the 70s and everything set those up so we could supplement our income. And the last things that my clients generally want to do is pull money out of their IRAs or qualified funds, 401ks or whatever, until they reach 72 and a half. That's the last thing they want to do because then they're going to pay tons more taxes.
Yeah, no, that's exactly right. All right, so let's wrap up. We've got about 10 minutes left here, and let's give a few actionable pieces of advice. So maybe the question I'd pose to you, Mark, is what are the common mistakes that you're seeing self-employed entrepreneurs
Yeah.
making? And what kind of actionable advice could you give them to avoid those mistakes or to pivot their business structure so they're building wealth, not just getting by?
Right. So, first of all, understand that that's your primary source of income. So, building your business is obviously an investment in itself. Now,
Yeah.
everybody knows that, but when you're in the weeds of doing the day-to-day operations of your company, you're trying to make as much money as possible and you're not viewing it because you're being, and
You're in
everybody
it.
in essence, yeah, you're in essence, everyone's a technician in their business,
Yeah.
right? Because they're doing the day-to-day things in their business. That's an investment and view it as an investment and look at it from an investment standpoint because here's the thing, every bit of cash flow that comes from that business, you're always thinking, how can I deploy that and how can I make it work for me and invest? Well, technically, you just made a return.
Hmm.
It's the one thing that a lot of entrepreneurs don't realize. They're just, I'm trying to get cash flow and have as much money left over at the end of the year, right? That's an investment return Okay.
Yep.
So that in itself, if you make it, if you cash flow and you profit 200,000 for the year in your business, that is a return on investment. And
Mhm.
often that's the best return that you're going to get on practically any type of investment. Okay. So that's important to think that. So even if you took that money, I'm not suggesting this, but even if you took that money and stuck it under a mattress, you still made a return on that investment. Does that make sense?
Mhm.
I'm not suggesting that at all, and we do a heck of a lot better than that. But you need to kind of view that as that way, and that's your primary cash flow, that's your primary investment vehicle, so to speak. Okay. So the really, really wealthy clients I work with view all of their different businesses in that way, not just the technical aspect of running the business and try to generate cash flow. Okay. So that's huge. And then we can deploy those monies in other ways to start then diversifying outside of what they're doing, which is super important to have those. Kiyosaki will talk about this too, have those different quadrants that are generating different types of, say, passive cash flow on their own that you don't have to be a technician about. You don't have to be there generating that. Okay.
Mhm.
So that's really big. And I think that's a key distinction. And but keep in mind that your business is your primary investment.
So Mark, I want to put a tactical lens on this and make sure I understood the advice you just gave me. So let me give you an example and you tell me if I got it or I missed that piece of advice
Right.
that you just gave. So one of the things that we realized in the real estate game was we were always thinking about in order to increase cash flow, we needed to go acquire another property.
Yeah.
And then properties got really expensive. And then we're analyzing deals and we're like, wait, we're going to deploy a bunch of capital to buy this property. And there's really going to be no cash flow out of that property once you figure out all the deferred maintenance. So
Right.
then we started thinking to ourselves, all right, well, instead of deploying capital to buy another property, why don't we deploy capital on the properties we already own? And upgrade them and
Mhm.
increase our rent. So we started reinvesting in the businesses that we already
Great
owned
idea.
rather
Absolutely.
than going and buying new businesses. So is that kind of what you're
And
saying? Like,
increasing your rent, all that. In essence, but I'm also talking about diversification because
mhm,
I do have a lot of folks that come to us that have been in real estate for years. Many of them are kind of a little burned out by it because they've worked so hard in it and
oh,
all of
it's
that.
work.
And but that's what they know, and they're like, well, I'm just going to go buy another property, another property, another property. And I said, well, that's great, but and I mean, I've had people that are worth $50 million that have come to me and that's all they have is real estate. Okay.
Yep.
It works for them. They've made money that, but they have no concept of what real diversification is. And so what I can show them is that, oh, okay, so what have you made in this particular property? Well, what's your goal? Well, I want to make 10, 11, 12% per year and everything. Well, say, well, why don't we diversify over here to something truly passive? Let's look at a private equity offering that may be even of less risk than what you're doing in your real estate. You don't have to work in it all, and it's going to throw off 10, 11, 12% anyway. Okay. And it will help diversify your entire portfolio and ultimately start taking some burden off you. I'm working with a gentleman up in Alaska now, one of the biggest self-storage guys up in Alaska, and he's got thousands and thousands of units and I mean tens of millions of dollars in property. And I could just see it on his face when I first, and he's still relatively young. He's maybe 45. And I could see it in his face when I was talking with him that the burden that this is, I got to be able to do something else. So we're doing a strategy where he's unloading some of the properties he's wanted to unload for years, but he was like worried about the taxes, worried about
Yep.
this, didn't know what he could do. And now we're taking that money and we're helping him build a more balanced portfolio. And he's even gone so far when we showed him the structure of everything we could do. Can I just make all my money? Can I get out of all my real estate and put it into there? And I didn't recommend that. And I said, no, I don't want you to do that. I mean, you want to keep your really, I mean, your properties that are really cash flowing well. but it was like this burden off of him to know that he could maybe take half of his portfolio and make it just passive, and he's going to probably make as much, if not more, than he was in his real estate holdings.
With probably a third of the headache because you get rid of all the headache properties, you keep the gems, and you're diversified. That's great.
Absolutely, absolutely, because he's worked his behind off and helped his dad for years, and he's just like, hey, I need something that is not so exhausting to manage, you
Yeah.
know?
Yeah.
So anyway, I'm making more of the distinction of uh, trying to think about thinking outside and other things you can do outside of that one asset class that's real estate. Okay.
Great.
Yeah.
This has been very insightful, and I would like to leave people with where they can get your book, first of all, and second of
Sure.
all, if they realize, look, I'm paying too much in taxes, I'm not diversified, and I'm not, I'm feeling a little stressed out, like this gentleman who owned thousands of units. Where can they find you and get advice and see if they might be a good fit for you?
Sure. Well, the best place to, real simple, we're old school. Go to our website, which is Hilton Wealth, hiltonwealth.com. Real simple. You'll see a pop-up there. You can order my most recent book, which is the Hilton Wealth book.
That's great.
Brad wrote it in conjunction with me. And it's just all the kind of just the little tidbits and the secrets of the things that the Hiltons have learned over the years to preserve their wealth and to get wealthier and wealthier and wealthier over the generations.
It's great. I'm going to throw you one last curveball because this is just something I'm curious about. I think a lot about inheritance being more than money, but it being knowledge, it being
Mhm.
a legacy of understanding that we can pass down rather than just
Yes.
dollars. And it occurred to me that, Brad Hilton now is the grandson of this legendary hotelier, Conrad Hilton. And what do you think it is that the Hilton family has done successfully to make sure that the grandson is still innovating and creating and building upon this amazing legacy that Conrad Hilton started? Because as a father, that's something I think about frequently. Is there any wisdom you could share with me
Yeah.
as a dad?
Well, are you ready for this? And you kind of touched on it there a little bit. Both Conrad and Baron Hilton were the two richest of the Hiltons.
Mm,
They left almost every penny to the Hilton Foundation, which today is one of the largest, generating billions of dollars a year. The Hilton Foundation gives away, and Brad's on the board of the foundation. They did that on purpose because they knew what they were really building was the legacy of the name
mm,
and the trustworthiness of the name. And what they said is, we want to give that to everyone because if we just give them money, and it's pretty much proven, and we've got people in our family office, hopefully they're not listening now, they probably know who they are. We know them well, though. In the family office, that there's people in their family that don't know the value of a dollar because they never had to make it.
mm.
And history will show you that generally that money's gone within the third generation.
That's right.
And I mean like 80% probability of that. And Conrad and Barron especially knew that. So about 95, 98% of the money that they made, they left to the foundation to do great work around the world. But there's a handful, and I mean a good handful of the Hiltons that learned how to invest from them, that have invested in real estate, all kinds of different, the markets and all that, and they've leveraged their name, the Hilton name, just like Brad has, to make multi-millions of dollars. And that was the real legacy that Conrad left.
That's incredible. He handed down the knowledge, the information, and the brand around the name and
Yes.
said, "You kids go make it for yourself. I've given you the biggest of the assets. It wasn't the dollars, it was the legacy and it was the knowledge."
Yeah, yeah, and Brad has such a great passion for teaching, and I do too. And then we just are kind of symbiotic in that relationship. That's has a passion to teach people these things. I mean, our biggest thing now is how can we, and that's why we do a podcast like this and things, how can we get out to as many people as possible? Because it's what everybody really needs to learn and know, what Conrad Hilton knew.
Mark, you're a gem. I've really appreciated our time together. I'm going to
Thank
leave
you.
you with a closing thought. If you have anything you want to share with our audience, please do. We'll make sure we have links to your website, links to
Yeah.
your book in the show notes so people don't have to go searching for it. But how would you like to close this out? Any parting words of advice?
Parting words, I love what you told me about your audience because this is the audience that I love the most because I'm a businessman. Any given time, I've had plenty of companies running and all of that. And you know what? We know the things we do are really the lifeblood of this country.
That's right.
And it's just that it's an honor to work with to business owners and people that are out there really creating jobs, generating cash flow, and it's just more power to all us entrepreneurs, right?
Well, we know how hard it is and how many nights at 3 a.m., we're still up working on something
Yep.
or something's got us, because we have so many responsibilities on us, so many people depend on us, we can't fail. And so I think that's a beautiful thing in the entrepreneurial spirit is we like to see other entrepreneurs win because we know how damn hard it was for them to be able to get there and to do it.
Yes. Yes. Maintain, what I say, and I encourage all my clients when we talk to them is just do whatever you got to do to keep your passion going.
Yeah.
Don't let yourself get into this rut of, and I try to do that. I'm involved in various organizations, just being around the Hilton family too, all the time. Somebody inspires me, just like, oh, I got to work harder. I need to do this. So keep the passion alive. Keep the passion alive.